the government of Rwanda has reiterated its commitment to raise the savings rate from the current 10.2% to a 20% of GDP by 2020. With this ambitious target, where does the national regulator, that's the Central Bank of Rwanda, where does it come into this particular equation? Uwase Masozera, Director General of Financial Stability Directorate at the National Bank of Rwanda, broke down how the regulator is fostering savings in the country. Take a look.
Well, the central bank actually comes in on several fronts. One, as a regulator of the financial sector, actually the entirety of the financial sector with the exception of the capital markets. So our biggest role really in that area is, as a regulator of the financial sector, is to ensure that we create an enabling environment for the financial institutions that operate in this space to be able to actually play that role of mobilizing deposits. So in terms of the legal framework that we put in place, is it encouraging innovation? Is it encouraging outreach across the country? Is it providing safety for the customers that the financial institutions are dealing with? We also come in on the macroeconomic front to ensure that the economy actually is operating in a stable macroeconomic environment, that inflation, for example, is stable, is low, because in instances where your inflation is high, as an example, it's going to be a disincentive for people to actually save in financial institutions. So we do come in also in our role of maintaining price stability. Also in our role as a protector of depositors, you will be aware, for example, for the case of Rwanda, that we have recently instituted a deposit insurance guarantee, which basically gives the public confidence to actually save, for example, in banks and microfinance institutions. We also come in as a lender of last resort, providing much required liquidity, for example, for a solvent institution that may be going through a tight liquidity period. So we do come in as a provider of funds that will actually ease the liquidity stress for the financial institution, thereby making sure that it actually is operating sustainably over the long term, and also contributing towards confidence of the market in such institutions.
It's very interesting, of course, when you mention the regulation and legislation to make sure that the frameworks are actually set in play. And one definitely has to ask themselves, where the capital adequacy ratios are right now, let's say 15%, wouldn't maybe lowering some of these, how hard is it for you as the central bank to actually find that sweet spot whereby you do not lower them so much that commercial banks actually take advantage or even take them up so high? How do you find this sweet spot?
It is actually indeed a delicate balance, because you want to be sure that banks, for example, are using their capital effectively. So basically taking on risk in terms of lending to the market. But at the same time, you also want them to have a sufficient capital base that will protect them in the event of any shocks or potential failure. So it is a delicate balance. So what we have done to sort of maintain, to decide on that sweet spot, the 15% that we have today, is we've benchmarked ourselves against international best practice, and also within the region. Of course,
Basel III here.
Exactly, for Basel III, which actually comes into play effectively next year. But we've also benchmarked ourselves within the region and agreed on certain criteria in terms of what are the baselines for core capital. I think we've agreed within the East African region at 10%, and then agreed on different buffers for systemically important banks, which on a global basis then comes to a total capital adequacy ratio of 15% for the case of Rwanda.
Let's bring it back to the microeconomics. If we were to look at savings as a whole, Many a times people actually do not get how vital this is. Now, this savings rate, tell me, what is in store for us? What's on the agenda, at least from the central bank, to make sure that this message is actually ingrained in every Rwandan's brain, to just understand the core value of saving, let alone investment, ultimately?
For this particular week, as a central bank, I think our focus really is on education, on re-emphasizing the message of the importance of saving and communicating the different channels that people actually do have to save. You know, oftentimes people save in tangible assets, should I say, or in kind. You'll invest in a piece of land, and those are important, yes. But I think this week what we are emphasizing is alternative options for saving. You can save through a bank account and in a bank or in a microfinance institution. But then there's also other avenues through which people can save. You will be aware, of course, every probably quarter, when we have treasury bonds that are being issued, we do run these campaigns to interest the public to. This is also another avenue for them to save. There's saving through life insurance schemes. Recently, we started to regulate the voluntary pension schemes. So that is also a complementary scheme over and above the mandatory scheme of RSSB, which also creates another avenue through which people can save for the future, for retirement in this particular case. So really this week is about education and showcasing the different avenues or products that are available to the public for saving.
Right. Something that's very fascinating is, again, I don't want to use the word sweet spot again, but Sweden, Scandinavia, is very interesting a country because they're now facing a problem where savings are over and above investment. So someone is just happily waking up, see a lot of zeros on his account, and goes back to bed and retires, and maybe that's taken over by the grandkids. In the grand scheme of things, how do you spar, as a regulator, how do you spar, foster people to just not only save, but after saving, encourage them to save, rather to invest? Are you supposed to maybe diversify the financial instruments that are already existing? How do you find that particular one?
That's actually true, because if we even look at our own scenario today, if you look at our access to finance numbers in terms of usage, you will see that the number of people that are actually saving, as an example, is growing steadily. But in terms of access to credit, that number is not growing as fast. So the idea should be, yes, we're encouraging saving, but for what? For us to be able to mobilize funds to invest in much needed, a diverse portfolio of needs that we have. If you look at our credit to GDP ratios, as an example, today we're at about 24% credit to GDP, compared to other places where it's 80s, in even some places over 100%. So there are opportunities to actually, yes, after you have saved, to then use to also access these savings to venture out into different investment opportunities that exist that will also be key in driving our economies.
A final piece, we do know Agaciro here is a sovereign wealth fund, and again, it's very interesting for me because well, saving is one thing, but if you have nothing to invest in, then you have the Swedish problem. So wouldn't one argue that maybe more sovereign wealth funds like Agaciro maybe need to be set up? Maybe not at that particular scale like Agaciro, but maybe even smaller ones, maybe even some that are private-led.
That is true, and that is true because in terms of investment, like I said, I was going back to the issue of our level of investment even within the country. There's clearly a lot of opportunity that still exists. In terms of more, I think even the starting point would be for us to utilize that which we have
What's existing
effectively. For example, one of the things that we've also, in terms of the diversification that we were talking about earlier, is you're aware of the informal saving groups that we have that operate at at village level and everything. So the idea is to think about how do we enhance what already exists? And one of the things that, for example, we're currently working on as a central bank, but in collaboration with other stakeholders, the Ministry of Finance, different NGOs that are operating in the financial sector space, is to see how we can create linkages between, as an example, these voluntary savings schemes, linkages between themselves and more formal institutions, so that in addition to saving, there's also creating opportunities for these people that are saving in these informal schemes to access other financial services, which would include, for example, access to credit, which they can then use to invest in different business opportunities that may exist. So in as much as, yes, there may be a need to diversify and have several more of initiatives like Agachiro, I think we still have an opportunity to effectively use those that we have in place
and consolidate
and consolidate the gains that we've made so far.